Welcome. In our last video, we had talked about two great opportunities for investors in the stock market today. One was the investments in small businesses in India, which we talked in that video. The second one was investing in the US technology businesses. So you will ask, what is so special about US technology when we do have technology businesses in India too? And some of us think that India leads in technology, at least thinking process. Yes, India has technology businesses, but we are only service-oriented companies which only do developments further on the platforms that is created already. And most of the times we are a body shop supplying labor to develop products for other companies. Whereas this is actually good because these companies are insulated from the vagaries that the local economy has, because their revenues are coming from the global economy. So when India market goes down, these businesses will not go down. That is the advantage of being invested in tech. While we don't have businesses that are creating a new experience to people in the world, like what businesses in US are creating. Take for example Google or Alphabet, the parent of Google, or Microsoft not for their Windows Office platform, for their Azure platform, cloud computing platform. Matchworks, which is a dating site, Salesforce, where sales, marketing, all are done in a unique way, and ServiceNow, recreating the work culture. These kind of businesses are creating so much wealth. They have multifold potential for growth. Well, these are businesses which we don't have in India. So let's look at what are the advantages these businesses have and how it will be a benefit for being invested into these stocks and how we can invest it. When we talk about US market, you may have thought that will come into the mind is it not that the US market is extended? Is it mostly talk that there is a recession expected in the market, and there in tech fund, is it viable? This will be the thought going on in the mind, because media has been talking all around that US market is ready for a recession. And as we talk, coronavirus has bleeded the markets globally. Let's look at how numbers are showing. This is a graph showing the growth that US market had in previous rallies. Every time we had a recession, and subsequently how the market went up. Blue is recession bars, and gray is the expansion after the recession had been there. On an average, recession stayed for 15 months, and after that expansion was there for 48 months. It's always a 1:4 relationship will be there. So in 2001 and all, when we see recession was for a limited period and expansion was for a very long time, 126 months of expansion was there. The strength of the performance of US market, currently it is said that it has been in the longest upside, this light blue line, while it has not caught the heights of previous rallies. Blue and red here, this has been the peak. After that it started correcting. Here it has not reached that level. This shows that there is a lot of steam left, and the speed at which it is going up is also subtle. So longest rally, it has not had the speed that what it had earlier and on. So once it reaches these peaks, only government will interfere and bring down pressure on the market. Now, as it is, if we see, government is easing out. Interest rate cuts have been there even in the last 1 year, and there is talks that it will not go up. Only if interest rate goes up, markets will correct. And US economy is also a consumption economy like India. 68% of the economic growth or GDP is consumption. So as long as consumption is there, and GDP is growing, economy keeps expanding. So, what is the chance that people will be spending? This is the unemployment rate and wage growth. If you see at the right edge here, unemployment is at the lowest in the last 40-50 years time. For the past 10 years, unemployment has been declining, and it's come very down, very much lower. It's somewhere around 4%. And wage growth has been increasing at 4% now. So income is increasing. People unemployed are very less. So that means there is more money to be spent. And of course, this curve will start moving up. And that is where the markets also expand. It's almost in the cusp, you can say. Every time it hit a bottom, or both the blue and gray lines are converging, getting closer, there is a expansion happening. Now we are in that stage. So there is a chance of expansion. And we talked about the coronavirus. Similar like coronavirus, we had the SARS virus in 2003. Most of us would have forgotten because bad things, memories get erased faster. Even most of the memories get erased faster. This black bars here is the impact that SARS virus had on the markets. At that time, when SARS came in 2003, China, Hong Kong, and India was the most impacted markets, whereas other markets were not much impacted. Blue bars are post the impact. What was the upside that market had? After the SARS impact on the market, we had somewhere around 2.5 times expansion. That is, when after market went down, it went down around 11 to 12%, and upside was somewhere around 20 plus percentage. All the markets across the globe after the SARS epidemic outbreak got started getting down. Markets went up dramatically in that period. So now since we are talking about US market did not go down when SARS virus was there. While when it started falling, that fear started falling, markets again went up. Now coronavirus, how it is impacting, these orange bars in the chart is the coronavirus impact. India did not have much impact. Well, of course, the epicenter for coronavirus is Japan, China, and Hong Kong. Those are the places where the impact also has been very high. India is somewhere insulated most of the part. Of course, we are having a correction. It is not to the extent of what the global market is correcting. If you see the US market, we don't have orange bar at all, but yeah, we did have a small correction there. It was less than 1%. That's why it is not showing. So all these kind of epidemics are just only a small impact on the markets. It only goes up again after the fear gets subsided. So need not worry when all these issues happen. It is actually a buying time, but people don't invest in these kind of fear periods because the media just bombards the people's mind with a lot of fear. Even yesterday there was news that 60% of the world is going to get affected with coronavirus. This is a pessimistic news being circulated regularly, and when this news hits the people's mind, they will not go ahead and invest. Actually, it is a very good time to invest because that is where we will have bonanza of returns coming on our investments. Going to how the non-correlation is, we can see about 10 markets have been taken for the last 10 years. You see, wherever India is on top, US is at the bottom. When US comes up, India is at the bottom. That means when India goes up, US doesn't go up that much. When US goes up, India that don't catch with them. India is at the bottom. In 2009, India made 102%, US made 26%. In 2011, when US made 2.1, India was minus 37. So advantage of this is having a small exposure to US market will help us have a small diversification, which will also help the portfolio have consistency, that will not have big volatility. The last 10 years, this pattern has been there. Average return the US market gave in the last 10 years was 13.6. India was 3.9. This is because of the correction period which we are going through in 2018-19. So having US exposure in a portfolio will help us have our equity curve. What we talk about equity curve is everyday growth and decline in the account. If you plot it as a graph, how it will be. It will become highly volatile, go up and down, having large impact. Having a small exposure to US market will reduce that impact. This is the chart of growth that the fund, US Technology Fund had. The dark blue line is the US Technology Fund. It is and the green one in the bottom is the India IT Index. If we have a 50% exposure to US Tech Fund and 50% exposure to BSE IT, what will be the return is the orange line. You can see the blue line is going up big time compared to the BSE IT. And when the crash happens, the impact is also very high. So that's what we were saying. Volatility will be very high. Of course, in the long run, all these volatility get eased out. If we see from 2017 to 2020, 4-year period, there had been volatility, big correction, which was somewhere about 20 to 30%. And after that, market keeps going higher only. So whenever market starts going down, people get into a panic mode. That is it over for the market? Will it go down to zero? No, it cannot happen. As long as human population is on the planet, consumption is going to be there, and consumption, as long as consumption is there, markets are going to keep going up only. So look at this asset as a long-term investment to generate income from it, and need not panic when it starts going down. That is the way this market behaves, and why we say there is high potential for the US tech funds. So all of us would have seen the PC laptop boom that we had in the world. After that, we had smartphones, and then it was followed by tablets. Almost everyone in the world, at least whoever is seeing this, would have seen or experienced all these growth in these three sectors, how it started and how it exploded. So similar kind of growth is possible for all these sectors. Here it is, this PC, smartphone and tablets have peaked out. Now what is having momentum is 5G, data center, cloud computing, electronic payments. This is what most of the people are talking. That's where activity is also happening today. These are showing very big growth, like Paytm, 5G, Geo kind of businesses. Those that are in the nascent stage, autonomous machines, artificial intelligence, autonomous cars. As of now, people will have uncertainty about how this will perform. While things will start, development phase will evolve, and when they come into the actual usage stage, growth is phenomenal. So this fund is being investing into only these kind of businesses, all the new age businesses, which has huge potential for growth. So that is the reason we are expecting good returns from this fund. As we talked about Alphabet in Google, um, Google's current revenue is $160 billion, and their profit is around $34 billion. Google's products, who is not using Google today? Without Google, man does not go to sleep in a day. That much Google has penetrated into people's mind. If you see if you have been using Gmail of late, it has started charging people. The space that they gave as free got over. Most of them are not hesitating to pay and use it. When 25 years back, when email came, we were rarely using it, because at that time post courier was famous. Now post and courier is not there. Email has become part and parcel of everybody's life. So now we are not bothered about paying a little. So that has just started giving revenue to Google. Similarly, their YouTube, which has started going premium now. Almost all of us are glued to YouTube. That's what we say. It's so much usage YouTube has, and the revenue has just started coming from YouTube. And Maps, who is not using Maps today? It's still not charged. So these are technologies that is already developed where it doesn't require any money more. When it starts generating revenue will be huge. This is one company which we have in the portfolio that this fund invests. Similar is the case with all the funds, that is all the stocks that are being invested in this fund. So there is potential for very high growth in this fund. One can think of not only having it for 3 or 5 years, just keep it for lifetime. It will keep giving you returns on a regular basis. This is the calendar year returns. In the last 1 year, US tech fund, how it has performed, it has given 6.4, whereas BSE is given 2.6. Having a 50% exposure to US tech, we would have had around 4.5. 2019, it was a boom year for tech funds. Generally, all the new funds come when there is a peak, only then they can sell. But need not worry. In the long term, we will have volatility, that is for sure, in any equity related asset class. But in the long run, we will have big returns, that is for sure. So need not worry that it is already expanded, it will shrink. If it is shrinking, not a problem. Keep in horizon of 5+ years or even little larger than that, then only funds will give, and you can enjoy the benefit of big returns. 2018, India tech outperformed. In 2017, again, US tech was a big upside. In 2016, we were negative, it was positive. So what is the up and down movements this fund could have? In the last 10 years, only 1 year it has had negative returns on the yearly closing, while in between a year, it can penetrate. Like in 2011, there was a penetration of somewhere around 26%. 2016, again, a downside penetration of 25%. That is, this much is a volatility that can be expected in this fund. So if it goes down, need not panic. It can have a potential of reaching close to 25-26% downside before closing in a year. Similarly, on the upsides, we have had 27, 29, 47, 42. This is the potential for upside. So when there is a down year, or a fund is underperforming, need not worry. The subsequent years, it will take over and give big returns. These kind of large returns it keeps repeating regularly. When it happens, it averages out all these negative performance years or lower performance years and gives us a better return. That is where the expectation is around annual return here. Average is around 18%. We can expect around 20% returns from this one. How it benefits if we add this tech fund? This is a JP Morgan tech fund, which the Edelweiss fund is investing, is already in existence. If we invest where Nifty is around 9 to 10% annual returns, whereas this fund is somewhere around 20+% returns. Having a 10 to 90% exposure to the tech fund in our portfolio, how we will perform is what this graph says. 10% we will slightly increase, whereas volatility also increases because standard deviation comes down. As the exposure goes up, standard deviation also expands, and of course, with the expanded standard deviation, returns also is very high. We would not suggest having a 90%, 100% exposure because most of us, though we talk on an upper level that I'm okay with being invested, I'm okay with volatility, but actual volatility, when it comes, we get into fear. So have a 10% exposure. It will become a small diversification. While our market goes down, this fund will be going up. So that way it will help cushion your fund overall investment to not have a bigger downside. So if somebody who wants to take little higher risk, maybe can go to 20 to 30%. More than that, not recommended. So, but on any portfolio, having 10% exposure to this fund will be very good. So what is the fund? This is the Edelweiss US Technology Equity Fund. It's a fund of fund because they are investing into a JP Morgan fund. Edelweiss bought out JP Morgan when they left India. So Edelweiss is a fund house which is launching this fund. Fund of fund has some uniqueness in that. Whereas in a NFO, generally, after collecting the funds, only money gets deployed. Whereas in fund of funds, it's an already running fund, so we can put money at any time. NFO just closed. As I'm talking, it's just a day that NFO is closed, but need not worry. In a week's time, it will get NAV will get listed. We can keep investing. What are the expectations? As we talked about, it is 20%. Have a horizon of above 5 years because volatility will be there. And taxation up to 3 years is on the slab because it's categorized as debt. And further to that, we have indexation benefit. What the indexation benefit gives us, if suppose we are making 100 rupees profit, our slab is 30%, our net tax outflow will be 33. 33 rupees is the tax we will be paying for 100 rupees of profit made. That is up to 3 years when it is on the slab. When indexation comes in, generally tax what we are paying at 33 rupees gets down to 11 rupees or 11 rupees 50 paisa. So we can save somewhere around 60+% of taxes if we stay invested for more than 3 years. Volatility is going to be there, very high returns. Taxation is going to be all along. So staying invested, reaping rich rewards of the technologies that is going to get developed across the globe, which will penetrate into mankind's usage in the long run. That is what this fund gives. Take advantage, invest, and reap returns. Thank you.